Hi, I'm Sam Scheitler from Clark Mortgages. I'm a mortgage broker specialising in more complex cases. A lot of the work I deal with is investment related, so I've got a portfolio of landlords, people that invest in residential, commercial property, people that flip houses, they buy on bridging and so on and so forth. But the long-term effects of buy-to-let rental always used to be you could pick a property at random in the market and it would make money on rent. And it was standard lets that got us to where we are for so long. It's interesting nowadays that owing to the changes in taxing of property income, owing to the interest rates being so much higher than they used to be, we now are in a position where it's quite difficult to be efficient in single let portfolios. And a big reason for that at the moment is that tax efficiency point of view. People have a legacy of portfolio properties that they have owned personally because that's pretty much all you had the option to do, short of doing commercial mortgages up until quite recently in the grand scheme of things. Nowadays, owing to the change in income tax where mortgage interest is no longer a tax deductible expense, it's now a tax credit that you get back. That basically means that higher rate taxpayers and above, anyone in that 40% bracket and above, is now basically paying an extra 20% because they're only getting rebated 20% of the tax from a tax credit. So that difference has now meant that it's so much more expensive for higher rate tax band payers who generally most landlords are probably going to be. It's quite difficult, to with the cost of everything to save up to buy another property without being in that higher rate taxpayer bracket. That income tax difference now means that in a lot of cases, people are looking to buying properties in limited companies set up solely for the purpose of owning property. These are called special purpose vehicles. Some people actually own trading businesses that they've bought them out of, but by and large, property investors use a special property solely made for owning property. That used to be quite uncommon, to be honest. There weren't too many lenders involved in it. The reason for that differs. I think lenders perhaps didn't understand it. They didn't have the structures in place. There's a lot more trust that goes into a solicitor to deal with things because there are things they require like personal guarantees. Because the difference between a personal mortgage and a limited company mortgage is a limited company is effectively the entity that takes the mortgage. You might be the director, you might be the shareholder, and you might be 100% owner of it, but ultimately the company is taking the debt. So what happens then if you defaulted on the mortgage? Well, if they didn't have a personal guarantee, they could only chase the company, or there'd be perhaps grounds for what we call piercing the corporate veil or so on. I'm sure a solicitor would tell you more. But ultimately, they want to take the path of least resistance, so they ask for a personal guarantee. Most lenders are going to be 100% guarantees. If we look at the more commercial end of the market, you might get 25%. Some might ask for a cash reserve. It really differs. Generally, the rule for mortgages, and this applies across the whole range, is flexibility comes at a cost. So the more flexible you want a lender to be, the more you can expect to pay. So anyway, nowadays, due to these income tax changes, it becomes, for a lot of people, cheaper to instead pay corporation tax on the profit a company makes and take a dividend out of that than it is to just take the hit on personal tax. There are other benefits to it as well. Mortgage interest, I believe, in a company is tax deductible, whereas, like I say, personally, you just get the tax credit. An accountant, I'm sure, will tell you the real scope of the differences. There are inheritance benefits. You don't own the property in your personal name. Therefore, it can be easier to transfer shares of property around because rather than moving a property into different people's name and paying stamp duty time and time again, you can move the shares into children's names. So there's inheritance planning that we do in these respects as well. As I say, flexibility comes at a cost, and lenders look as limited company borrowing as a flexibility. So there are fewer lenders available interest rates tend to be higher. Cynically, I might say it's lenders cashing in on your saving. There's definitely more cost involved to them to set it up because they have more documents that they need to sign, because there is more people involved in it. It's a more complex legal structure. So the ownership structure can be interesting as well. In the more what we call vanilla in mortgages, means basic, basically. The vanilla limited company buy-to-lets, it used to be that a shareholder had to be a director, which meant you were on the public register, you were showing on Companies House, and that was it. And more complex lenders would allow for a more complex ownership structure. I think now a lot of these vanilla lenders are opening up to a more diverse ownership structure. You know, the reality is not everyone wants to be the director of a company. Not everyone can be, actually, as well, from an employment standpoint, even if it's for limited company buy-to-lets. There are people where actually they're not allowed to be directors of other businesses. So whatever the reason is, people can now also be shareholders but not directors. And the extra flexibility on top of that, as I was saying, is you can apportion shares to children and you can create intergenerational inheritance at that point by giving a small shareholding. A lot of lenders will ignore minority shareholders. They may only require owners who own 50% or 25% or more to be privy to the mortgage, which means small portions can be apportioned away to children or whoever you might want. There is a basis nowadays for personal properties going into limited companies. If you have this issue, just know that you're going to pay stamp duty, because remember, the company is buying it from you. It's not a remortgage. The company buys it from you, so the company pays stamp duty. Because you personally then sell the property, you also pay capital gains tax. Are there ways around that? Yes, speak to an accountant, but generally speaking, that's not a route open for most people. Instead, your company buys it from you, but it might be the lesser of two evils. You pay that stamp duty on a one-time basis, you pay that capital gains tax on a one-time basis, and you can then benefit from your large portfolio. It's probably not worth it in the case of just one or two properties. You might as well just sell it and rebuy, or remortgage and rebuy. But in terms of large portfolios, that could be quite a dramatic income tax saving that you make by moving it into that limited company. But ultimately, I'm not an accountant. I'm a mortgage advisor. I deal with the getting of mortgages. Your accountant is the one that needs to get it. I don't think you necessarily have to instruct the accountant up front. Some people love to speak to their accountant first and talk about their ideas. And if you've got a good relationship with them and they give you free advice, brilliant, do it. But, realistically, if you've got money that you want to invest. So just compare the options of personal to limited company. And if you've got a good accountant, then they'll be able to tell you, well, actually, it seems more efficient to do it this way or this way, or however that is. The accountant can deal with the setting up of the company. You can deal with it as well. From a mortgage standpoint, you just need to deal with getting the right SIC code, which is the purpose for business, to make sure that the lender accepts it. So yeah, speak to an accountant. If it's to your cost, I probably wouldn't bother doing it up front. I'd decide and wait and get the options and then speak to one, then instruct one. I do think, though, most good accountants who really want to deal with you probably don't charge time. I can't speak for everyone. It depends how busy they are, I'm sure. So yeah, limited company buy-to-lets, definitely worth looking at if you're not doing so already. I think at the end of the day, who wants to pay more tax?